Welcome to Kitco News. I'm Niels Christensen. So we've seen the gold-silver ratio drop to its lowest point in 3 months as investment demand in silver starts to surge again. Joining me today to talk about the precious metals market and prices is Lior Gantz, founder of wealthresearchgroup.com. Thank you very much, Lior, for joining us today.
Thanks for having me. Happy to be here.
So we've seen silver prices push above $17 an ounce. But this market has disappointed investors over and over again. What are your thoughts on the silver price today? Is it sustainable above $17?
So I think investors have to accept that the gold-silver ratio of old, the 12 to 1, the 16 to 1, 31, 60 to 1, everything that we've been seeing for the past since biblical times, and of course in the 20th century and early 21st century, those are not the new norm for the gold-silver ratio. Gold is being treated as money by institutions, by central banks, by governments. Silver is an industrial metal with a little bit of investment demand in times of either a reflation or something else. And for the most part, silver is, because it's an industrial metal, it has no premium as a monetary metal. We wrote a lot about this at wealthresearchgroup.com/gold playbook for the Kitco listeners. It's a special report free for download. And what we wrote there, Niels, especially, is that look, gold is a hedge for purchasing power. It's returned about 6.6% annually since 1971. Actually outperforming the S&P 500 since 1971. So think about that. In fiat monetary times, gold has been very well, and it has performed in the last 20 years amazingly. And what I think is important to understand is, from a capital preservation perspective, what I did, and I talked to you off the air about this, I took 2 years worth of my living expenses, and I just took 24 months. So for example, let's say it's X amount per month times 24, and converted that into physical gold. And holding that, if there's a 2-year recession or even a depression, I have 2 years worth of booming lifestyle preserved as gold. So if something comes along, there's that. For silver, it's much more of a trade. If you remember the March lows just a couple of months ago, silver got slapped all the way down to $12 an ounce or thereabouts. That was a trade. If you went into the options market, you could have made great returns. And actually, we did that, right? With silver, it's much more of a trade. It's much more of a short-term bursts that can happen. I don't see silver doing this 6.6% over time until somebody or some government monetizes it or claims it to be money again, etc. So that's at least my perspective. Don't expect the gold-silver ratio to go back to 12 to 1, 16 to 1, or even 30 to 1. It's definitely looking very nice right now with 120 to 1, etc. for silver. But I think for silver, if we're going to see some sort of repeat, then we can talk about this, of 2009 to 2011, then there's a good chance for silver to do something big. If not, then my preferred choice would be gold.
Do you think silver has more to run? I mean, obviously, I like what you're saying. The time to buy was at the March lows, and it's had a really good run. Is this it then for silver? I mean, should we be looking at gold as the investment to hold?
So I think again, as a long-term hold, physical gold superior to physical silver. Now let's talk about trade or in short term. So short term, if you're looking to make a big annualized return in the next month, 2 months, 3 months, etc., you're already seeing the silver miners doing very well. In fact, one of Wealth Research Group's clients, First Majestic Silver, is up substantially. And actually, CEO Keith Neumeyer said we're going to suspend silver sales. So he even made a sort of a bet in favor of his shareholder and said, let's hold back, let's sell silver at higher prices. So you're definitely seeing that silver is not yet loved. There is no volume, and you can attest to that at Kitco. If people are rushing to buy silver, we did see a lot of premium on silver in the March panic. But as a whole, investment demand is definitely not what it was in 2011. nowhere near, and nowhere near what it was in 2016. So I think silver has more to go, for sure. Now it's you can't put a price on it, so you can't say, hey, I think it's going to $25 or $21, etc., because there is no reference point. You can say, hey, historically that's what it's done, etc. But silver will get some sort of a premium from investors if they see a reflation, which could happen. In 2008, QE and TARP, etc., all of that money supply made investors think that there's going to be hyperinflation coming. It didn't. It didn't, because the money supply was kept within the circles of the banking sector, and it grew asset prices, some asset prices. By 2011, everyone saw that, hey, there is no major inflation here, and gold and silver sold off. In 2020, what we're seeing right now is not a real recession. You're not seeing a recession that was caused by stupid mistakes by CEOs of some kind, or by the consumer, or some improper risk taking. You're seeing a health crisis that caused quarantines, that caused a economic crisis. The solution, though, the overreaction to the health crisis created an economic crisis. Now they're trying to make everyone whole. The working thesis of Jerome Powell is that if you can avoid an insolvency for an individual or a small business or corporate America, it should be done, because of the mental residue that an insolvency leaves in your life and all of the hassle that has to go. So if they can float households, if they can float small businesses, if they can float corporate America, that's what they want to do. And that's why they're doing something different. They're injecting money into Main Street. Now, you're not looking at a trickle effect as in 2011 or in 2010. You're looking at money that is actually going to the system. And that has the potential, if consumers say, hey, gasoline prices are low, they're going to be higher next year. Or vacations are low now, they can be higher. If the consumer has inflationary expectations, Niels, inflationary expectations are what create inflation more than anything else. It's sort of a self-fulfilling prophecy with inflation. So if that's the case, then we do have a chance for higher inflation. And with zero interest rates, you don't need 6 or 7% inflation to rattle the boat. 3% is enough to, over time, over the next 5-6 years, create a situation where savings will be very problematic, and then it's cascading. I think silver has a very good chance in that scenario to be higher.
Well, let me just ask you. I mean, obviously you're bullish on gold. I mean, you like gold, you like silver, but is the way to play this through the miners? I mean, we have seen production increase, costs lower with oil prices where they are. Is this now the time to take advantage of the miners?
Well, the best time was 2015, right? 2015, 2016. So, and it's important to put that in perspective. This is not a bargain market. In the S&P 500 right now, there are 100 companies, literally a fifth of the index, that is down between 40 and 80% in 2020 alone. Another 100 companies are down between 27% and 40% in 2020 alone. Another 57 companies are down between 27% and 20%. So 257 companies, half of the index, is in a bear market, a very bad bear market. If you're looking at companies that are up, it's not the rest of the 243, because 113 companies are down between flat and minus 15. There are only 100 companies that are up. The best performing company in the S&P 500 is Newmont Mining in 2020, up 56%. A lot of these major miners are leading because, one, they're not suspending dividends; they're actually increasing dividends. They're looking good. They haven't suspended guidance or made investors, confused on what the future outlook is like. It's a pretty simple business. You put money in the ground, you get gold, sell gold. The second thing to keep in mind with the gold miners is that they've had a very bad bear market. If you look at the TSX Venture from 2007, it's down 80 86%. The exchange itself is down 86% since 2007. So think about that. It's an entire exchange. The value destruction that this sort of a bubble or whatever you want to call it into tech companies has created has made gold and other commodities very cheap. I do think that with the GDX at 7-year highs, the GDXJ not even at 2016 highs, there's a clear gap between the performance of the seniors or the big companies and the juniors. The reason is seniors have gold, juniors have stories. So when the large caps are going to be ready to make mergers, acquisitions, buyouts, etc., that's when you're going to see the juniors come into the table. In terms of risk reward, remember the most important thing is diversification. So if you're taking positions with commodities in general, what we always have said is put only 15% of your portfolio in commodities in general. 85% put in cash flow, something, things that are not cyclical and won't give you a heart attack. And in 3 to 4 months, if the thesis works itself out, then you're going to see some big moves. There are some very attractive plays out there, and I'd like to just give you a little bit of the analysis behind this. For one, Basel III. Everyone's aware of that. April 2019, central banks changed gold into a tier 1 asset. That means for central banks that day, gold was about 1,278 when they said that. In other words, in the day that they said that, they actually told the markets, we don't believe gold is worth 1,278. We believe it's worth double. So the central banks, gold is worth $2,578 an ounce. There's still a lot of room between 1,750 and 2,500. So think about that. Think about the fact that the world's biggest buyer of gold thinks that gold is undervalued. That's one thing to keep in mind. Secondly, peak production. The first peak production that we can talk about in modern times, 1970. In 1971, they decoupled the dollar from gold, and gold goes on a 2,400 move in 10 years. Second time that gold went into peak production was in 2000. From 2000 to 2011, gold did what only gold has done in history, 11 straight years of going up. The third time gold peak production, 2017. So if history is any guide, you're in a bull market right now for gold. And the third thing that I think is important is why Basel III happened. Why did they change it to tier 1 all of a sudden? And the reason is central banks understood in 2018, in December of 2018, that real rates are not going up. They tried to raise rates in December of 2018, and it wasn't the government or government bonds or servicing government debt that held it back from what caused the monetary U-turn is the fact that corporations and households are now can only function at zero rates. If you raise rates, it's done for corporate America, for the Russell 2000, etc. Real rates are not going up if they can help it, and that's why they changed that. So gold is not in the mainstream news right now. Nobody's talking about the fact that it's up 70% or 75% since 2015. Silver's not in the news, and more importantly, we haven't seen really any sort of an institutional pivot to gold. I think once gold goes and passes that, and it's only 9% away from passing that 1930 an ounce, so 1930, which was the intraday all-time high on September 5th, 2011. Once it surpasses that, it becomes mainstream news. Then you'll see retail come in. Then we start the real bull market, right?
Lior, thank you very much. This has been a really interesting conversation. Thank you very much for your advice.
No problem. Thank you, sir.
Thank you very much for watching Kitco News. For the latest in the precious metals markets, go to kitco.com. Thank you very much. Stay safe and stay healthy.